Roy is going to facilitate the conversation with John. And Roy, who in the industry is known as a true real estate insider's insider, Roy is the CEO of Eastdil Secured, which is a real estate investment banking and brokerage company. He previously served as its president. A longtime Eastdil executive, Roy's advised world-class clients while facilitating some of the industry's highest profile investment and finance transactions. Roy has also been a director of the Real Estate Roundtable since July of 2008 and serves in other high-level positions with a variety of real estate industry groups. Additionally, his family foundation has launched an internship endowment for economics students at his alma mater, the University of California, Davis. For many of you, I don't need to introduce John, but I'm going to do it anyway. John is the global head of real estate and a member of the board of directors of Blackstone, where he also sits on the firm's management committee. Since joining the company in 1992, John has built the largest real estate platform in the world, with nearly $81 billion in investor capital under management. Blackstone's portfolio includes hotel, office, retail, industrial, residential properties in the United States, Europe, Asia, and I'm sure I'm missing some properties in some locations, maybe Australia. John serves as chairman of the board of Hilton Worldwide, chairman of the board of Harlem Village Academies, and is a board member of the Trinity School. Together with his wife Mindy, John established the Vassar Research Center at the University of Pennsylvania School of Medicine, which focuses on the prevention and treatment of genetically caused breast and ovarian cancers. John earned his bachelor's in economics from Wharton, as well as his bachelor's in English from the University of Pennsylvania. Thank you guys for being with us.
Thanks,
Bob.
Thank you. Well, how are you?
I'm good. How are you?
Good, good.
I always want to leave after they do the intro. I wish my
Exactly.
kids
Thanks,
would come.
Mom.
That's good. Yes.
Exactly. Well, as I was preparing for this, I looked back to try and provide a little bit of context for this conversation today, and I realized that pre-GE, that we've actually, between advisory work and financings and sales 4 and 2, IPOs and all the rest, that we've done about $200 billion worth of stuff since 2005.
Wow.
Since you have been, in fact, in place. Your comment, I think, earlier might have been that it feels like we did that in the last 2 weeks.
Yeah, exactly.
In any event. And what I want to do today is I want to talk a little bit about the real estate activities of Blackstone, some of your investment philosophy, and then I think as much for the students as the professionals here, talk about what you think goes into being a good investor, what it's taken to ultimately build a culture of excellence at Blackstone, and candidly some advice for people who are interested, young people who are interested in the real estate business and as a career in the profession. So what I'd like to do is start off, let's just talk about this grand scale of Blackstone in terms of all the activities that you're involved in. And then I'm going to press you a little bit on how you manage these different pockets as well.
So, thanks, by the way. It's great to be here with everybody. I guess starting at the top, as of last week's announcement, we're at $93 billion of investor capital under management. If you add the debt on the properties we have, it's over $140 billion worth of real estate. So those numbers are obviously very large. When you think about how you break that up, about 80% of it is in what we call opportunistic real estate. This is where we buy things that are in some way broken, undermanaged. Could be a capital structure, could be an asset that needs to be released. We fix it and then we sell it. And we do it through a series of closed-end funds around the world. We have a very large global fund that there was some press about a couple weeks ago, 15+ billion. We've got a $7.5 billion European opportunistic fund and then a $5 billion fund in Asia. And we do Latin America out of our global fund. The balance, 20% of our capital is in our debt business. We have a public mortgage REIT called Blackstone Mortgage Trust that lends to real estate private equity firms and developers. We've got a high-yield sort of mezzanine debt fund of $4 billion that we run that lends to real estate investors in the US and Europe, and then we do some public real estate debt as well. And then the final piece, the newest piece, we got into the Core Plus business, and we've been buying more stabilized assets, longer-term hold, less risk, less leverage, with the idea that these are the sort of things that we could hold for a very long period of time for our investors who are looking for a little bit lower return, but for more duration. And that business today has grown in about a year from almost nothing to about $5 billion of equity. So,
And your partner is extrapolating to $100 billion in the Core Plus fund?
yeah, so Steve
No
Steve has said a couple times that the business could grow to very big scale. And he's right. I mean, will it happen overnight? No, but if we do a really good job, the business has tremendous potential. And the one thing I'd say, you know, people ask, how does a business get this large? How does any investment business grow? And you'd love to say there's some mystery. There's only one thing that makes an investment business grow, and that's delivering great performance. Once you stop delivering great performance, then the capital leaves you. You don't attract new capital. So for us, as we move into all these different geographies and different asset classes, everything we do, we have to excel. We've got to have the right team. We've got to have the right process. We've got to deliver the right returns. As soon as we stop doing that, that's when the game ends. And so for us every day, we wake up knowing we've got to deliver for our investors. And our investors are primarily public pension funds. Their beneficiaries are people who are going to be retirees down the road. So we think about it as a really significant responsibility. And we know we've got to deliver for them. But that's the key thing in a business like this.
Well, and I think that it's interesting how the evolution of these different funds have occurred. And I think it's unique, not that people don't try to broaden the opportunity set in their business itself, but I think that a lot of this has been in response to, you know, the investor's interest. And a lot of that, in my opinion, has to do with the fact that while you have a marketing group that does a lot of the pre-screening, if you will, you're in front of these investors, not just for the star power of John Gray, but to listen. And I think if you could talk about how, in fact, the Core Plus Fund has evolved as a result of that listening, it would be interesting.
Well, look, your investors in our business, they're the key. As I said, you've got to deliver for them, but the keys with your customers is to understand what they want. So beyond just delivering good returns, oftentimes they want it in different areas. They want different risk profiles. So the way the Core Plus business came about is a number of our big investors said, look, we love what you do in the opportunistic space. You buy a company that's in financial distress, you bring in a new management team, you deliver great returns, you sell it, I get the money back, and then I've got to find something new to invest in. I'd love to find something you guys did where you held the assets for a longer period of time. You used your same network of relationships, the advantage you get in terms of information and scale and buying things, but doesn't need to take on quite as much risk and give us a little more current income component, less about just all capital appreciation. We'd love some of that as well. We'd love to use sort of the Blackstone system in this different area. So the business really came out in a response to investors. And what we're finding as we've grown our business is there's great informational advantages from knowing what investors, buyers, sellers, financiers of real estate are doing around the world. And you know, one of the things I love about my job is I was in Spain the last 2 days, part of it running around in a van looking at warehouses and shopping centers and office buildings and residential units and all that. It just gives you a great perspective of what's happening in that market. And oftentimes you can learn from what's happening in that market and apply it in different places. And in fact, you know, in the US, we made an enormous bet on US housing. When the market bottomed, we went out and we bought 50,000 homes. And today we're making another significant bet in Spanish housing because we think there'll be a recovery there in Spain as well. So seeing things in different markets, listening to your investors, what they want, just being open and consuming lots of information are all helpful as you try to analyze where to deploy capital.
Yeah. So what did you learn just out of the US-based single-family residential investment that you're applying ultimately to Spain?
You know, what we learned is, like any sort of hard asset class, when prices fall a lot, that's generally a good time to be buying those kinds of assets. That you're buying, let's say, homes in that case at big discounts to physical replacement cost. That the market responds by shutting off new supply. So in the US, we saw that people stopped building homes. And that over time, with some population growth, recovery, GDP growth, capital markets improvement, home prices ultimately have to come back. They have to move back to physical replacement costs for there to be new homes built. So if you looked at Spain today, you'd say, gosh, what's happened? Home prices have fallen more than 40%. New supply of homes fallen more than 90%. And yet there's still 40 plus million people who live in Spain. And my guess is they'll still live there 5, 10 years from now. I'm sure plenty of you have been there. Beautiful place, nice people, great food. They've been through a very difficult economic period, but we think the place will come back. And one of the challenges as an investor is to not just look at the world the way it was yesterday or whatever, but to try to extrapolate. And so our experience seeing the way US housing recover definitely informs the way we think about the Spanish market. Now, will the Spanish economy come back as quickly as the US did? Will the housing prices come back? Maybe not, but the basic idea that there was an excess of assets built, of homes built, then there's a cessation of building, prices fall a lot, those prices recover to a level at some point where you can start resuming building. That basic idea you can apply over and over again around the world.
Right. And I think that as you looked at Europe and your big push into Europe several years ago, that one of the advantages you saw with relationships and knowledge here in the States is how the financing markets might ultimately come in behind your sponsorship and others to be able to play in scale, whereas others thought that the financing market was dormant then.
It's the same thing. So one of the things that happens when markets go down and you have great dislocation is capital dries up, both debt and equity capital. And ironically, when you buy assets in a market when there's no financing, that's generally when you're going to get the best pricing. And people run their models and they say, gosh, the return's really low because I'm buying this building with all equity, and it's really scary. Well, the truth is, the price you pay is permanent, financing's temporary, and will change as markets recover. So you certainly could watch what happened in the US 3 or 4 years ago as the debt markets healed, coming out of this crisis, and as that happened, debt became more available, asset prices started moving back up. One could logically look at Europe and say, gosh, look at Europe, prices have fallen dramatically, there's very little debt. You can't really borrow because the banks are all pulling back. As a result, you can buy assets pretty inexpensively because people are forced to sell assets. Maybe we should move in here and buy some real estate, and maybe the fundamentals will start to get a little better, and maybe the capital markets will improve as well. Now, I think we've bought now over $30 billion of properties, invested 11 or 12 billion of equity in Europe in the last 3.5 years. During a period, most people were waiting for the all clear sign, and we went in. And if there was one point I was making to folks here, as you think about going into either investing in real estate or other things, taking a differentiated view and having a willingness to take risk when others aren't tends to pay dividends. Because most people want to do something that everybody else is doing, but by the time that happens, the prices tend to be a lot higher.
Yeah. So it hasn't always been investing in the down cycle through the up cycle. There are a couple vintage 2006, 2007 transactions, Hilton and EOP in particular, that look pretty dire at one point in the cycle itself.
Yeah, they weren't asking me to do panels
in
2009.
Yeah. You were doing funerals.
Yes,
so,
I don't know what I was.
But how did you manage the business during that period of time? And obviously both of those are turning into success stories. What was it about how you were positioned as a firm and how you were positioned in those investments that ultimately made a difference in terms of being able to recover?
So I'd say a couple things. I'll start at the end and then maybe go back to the beginning. EOP today, which we bought for $39 billion, our investors are going to make more than 3 times their money. We bought it in February of 2007, the day the REIT market peaked. It has not, I'm looking at Bob, gotten back to that number yet, but our investors did well. I'll talk about that in a moment why. In the case of Hilton Worldwide, which is a company based not too far from here, we bought in July of '07, arguably worst timing. We closed in November, and today our basis in the stock is about $8.60, and the stock on the screen is north of $30 today. So another exceptionally successful investment. But it was not always that way. And in 2009, both of those investments, in the case of Hilton, I think we marked it down on an unrealized basis to less than 30 cents on the dollar. And we had marked down EOP at some point, I want to say to about 65 cents on the dollar. Unrealized, but nevertheless painful for our investors when they saw our results. So the question is, why did those transactions end up successful when virtually everything else that was done in our business in 2007 ended up, the investors lost all their capital?
A lot of which were spun out of the EOP and other
Some of
other
which
gifts,
was, yes,
other gifts.
yes, but we didn't know that at the time. So I'd love to say we had clairvoyance. We knew exactly what was coming. We were prepared for it. That was that. No, we did not. What we had was, and it's interesting, it goes back to a transaction we had done back in '98. We bought the Savoy Group in London, 4 super luxury hotels in London, and we had a bit of a near-death experience where the markets turned down sharply after 9/11, particularly the hotel business, and we had covenants on our debt, and we didn't have adequate cash, and we ended up nearly losing the business. We had to reinvest. We saved the business, it turned out. But that really, for me personally, reminded me that whenever we're doing something really big, it's critical that we have staying power. Because the story of Savoy, the story of the Westin St. Francis, which is another nice hotel in San Francisco we once owned, was that good real estate tends to appreciate over time. So the key is to not get stopped out at the wrong time. So if you go back to the '07 period, one of the critical things we did was put in place capital structures that allowed these businesses to survive. 5-6-year terms on the debt, no amortization, mostly floating rate debt in case the economy slowed down, so it was more correlated. Interest rates we thought were more correlated to economic activity. Put plenty of cash inside the underlying businesses. And with no covenants that could force anything, we could afford to ride through a storm. And have the funds that own these assets keep plenty of reserves so that you never know what's going to happen, and that turned out to be really important. I think the other key things were, at the time, we paid reasonable prices for those companies. I described it on the street. Assets were trading for 20, 25 times cash flow. We could pay less than that on the screen because there was a discount to the private markets on the screen. So even paying a premium, we were buying the assets better. In the case of EOP, what looked like a very aggressive thing we did, buying $39 billion of real estate, thanks to Roy and his team, we had basically sold off $30 billion of that, half of that 30, basically prior to closing, the rest within 60 days or so. So we felt like we were match funded, and that the basis we kept in the remaining assets that we would end up holding through the storm was reasonable. So in that case, we bought really high quality real estate inside this company. We sold a lot down. We had a good basis. We had a good capital structure. In the case of Hilton, again, we had a really good capital structure, and we had what we thought was one of the great businesses in the world, a franchise and management business where other people build hotels, and you don't put up capital, you just give your system and expertise. We also had a company that hadn't been run maybe as aggressively as it could have been, and we brought in a tremendous CEO in Chris Nassetta, and we had a simple idea that Hilton was, we thought, the leading brand in the US, and yet none of its other brands outside of core Hilton were outside the United States. So Hilton Garden, DoubleTree, Embassy Suites, so forth, Waldorf, Conrad, let's bring that to the world. So despite the crisis, that business kept executing. Chris kept growing. It kept growing rapidly outside the United States. The company moved from Beverly Hills, California, which was a good metaphor for how it was run, to Tyson's Corner. And we kept executing. During the downturn, because we believed in these businesses, we went out and bought a bunch of debt in both cases at significant discounts. And because we were sort of built for a storm, we rode through it. And as the world came back, these businesses performed very well, and there was a lot of demand for them. The other thing I'd point out during the crisis, not only important to be defensive, but I think being offensive, back to my earlier comments, is having the confidence to jump back in. So in the summer of 2009, we bought a half interest in the biggest office complex in London when everyone said financial services was dead, nobody was going to office in London, in the city anymore. Buying US homes. Going into India in 2011 and 12 when people said India was gone, it was never going to come back. Looking at the world in a different way. So I'd say for us, it was the two key things. One being set up on a defensive basis with the assets we'd invested in, good basis in the underlying assets and the right capital structure, and then on an offensive basis, having the willingness to invest. And we put out of our investors' capital over $45 billion of equity since the summer of 2009. So it doesn't always go in a straight line, I can tell you that. And you sometimes need a little bit of an iron stomach to get through it. But if you fundamentally buy good things, have the right people running them, capitalize in the right way, if you can hang in there, it'll work out.
I'm going to zip through a couple sort of headline deals, and then I want to get to a little bit about how you built the culture and the organization, which I think is critical to scale and I think important to the students in particular. But so let's go through. I mean, you talked about EOP and the sell down initially, and now we're fast forward 2015, 1095 3 Bryant Park, EOP Boston.
So we rode through the storm, we held the assets, and now we're in a different kind of market, right? We're past the distress phase, capital's recovered, people like real estate again, particularly in a yield-starved environment. There's not a lot of building, the fundamentals in real estate are good, and if you can create stabilized core real estate assets, there's a pretty good bid for those things. So we sold off our Boston portfolio. Roy, in full disclosure, and his team did it. And we got very good interest from sovereign wealth funds and core institutional buyers. We sold off the largest asset we own, 1095 6th Avenue, at the corner of 42nd and 6th Avenue across from Bryant Park in New York City. That single building went for $2.2 billion. But that was a great example of an asset that we had fixed, that we reskinned the building, leased up the entire office space, created great retail at the bottom, and then ultimately found an institutional owner, one of our investors, who wanted that kind of core asset for their portfolio long term. And in those cases, we were able to get great prices on a cash basis because the market wanted those kind of assets.
In fact, that investor was looking at a bond equivalent analysis and using real estate as almost a proxy for that with a little bit of inflation hedge.
And I think they made, given what's happening to Bryant Park in that area, I think they made a terrific investment.
We'll be back to you on that one. No, just as a proof of theory. So those are now in core. Okay, yeah. There's a situation where you know 4 years ago you owned no industrial. You put your toe in the water as part of BREP, and all of a sudden you owned 117 million square feet of industrial that looked like, from a scale perspective, the only place to go was the public markets.
Yeah, so we didn't know a lot about industrial 4 years ago, but during the crisis, a lot of people were over-leveraged, a lot of people were forced to sell things, and we assembled through 20-plus deals, transactions from the Lehman estate. There was a troubled industrial company called CalWest on the West Coast. We actually bought some assets from GE earlier. We just did a series of transactions, and we really liked industrial because, again, we thought the U.S. economy would come back. There was no one building at the time, which is always the risk in the warehouse business, and we liked what the internet was doing to that sector in particular. And so we cobbled this together. We assembled a great management team in Chicago, and we built up this company, and we planned to take it public. And if I had been sitting here a year ago, I would have told you we're going to think about taking this business public. We filed. I'm sure Bob and his guys were going to buy the stock. It was a great company. And one of our investor partners, the government of Singapore, very smart global real estate investor, said, you know what, we really like this platform. We want to own it. We said, look, we'll think about it, but only if we can get the same price we're going to get in the public market. because, we'll take cash, we won't take a discount because we think the company could do well, but it makes sense for us if you can do this. And they worked really diligently and quickly, committed to the transaction. We ended up selling it to them. Not what we anticipated, but a good outcome for our investors because we generated a very favorable return.
Right. And in terms of your existing investors, you candidly didn't risk any execution on that because you were prepared to actually go to market versus sell it to them at that moment.
And we do that often. There's another business we're working on in the UK today where we do the same thing, sort of a dual path, because you don't know what the best execution is. You don't know where the public markets are going to be. For us, we're agnostic. Our goal is to generate great returns, do it with integrity, and whatever's going to give us the best outcome we do. Sometimes it's stock, sometimes it's cash, sometimes it's a bit of both.
So why the Willis Tower?
So the Willis Tower, I grew up in Chicago, so I always think of it as the Sears Tower. And I got to tell you, of anything I've done, my mom is most proud of this transaction. All her friends called and emailed about that. So, and that is not the reason we did it. There were a couple factors behind that transaction. One is just a mega trend that's interesting today, which is what we're seeing in cities around America is a flight back to cities, particularly because young people want to live in them. 10, 15 years ago, you would see double the rate of absorption of office space outside the downtowns in the suburban areas. And now it's inverse, maybe even more. You certainly see this in places like Brooklyn versus, let's say, suburban New Jersey or Westchester County. And so we believe what's happening in Chicago is good for demand. Secondly, this asset, the existing ownership had done a nice job, but there still was some vacancy in the office building. It was in the low 80s occupied. We think we could lease it up. And we thought there was real potential in the observatory. 1.6 million people a year visit the Willis Tower because it's the tallest building in Chicago, second tallest building in America. And we thought we could do more with that and create more of a holistic attraction, maybe add other entertainment, more retail, do more to exploit this. There's a great antenna business that sits on top of this. And when we broke apart the pieces, we thought we were buying the office space for less than $200 a foot. So for us, it's a classic buy it, fix it, sell it. The folks who sold it to us did well with the investment. We think we can also do well. Good trends in terms of office leasing demand in Chicago, not a lot of new supply, and some real opportunity to add value with the asset.
I think also in that case, the fact that there was existing debt that you could assume as opposed to looking at it from a payoff perspective was a big advantage for you in that scale and size as well.
And there's no question that these big deals tend to be our sweet spot because there are just fewer players. One of the impacts of the financial crisis is that our big competitors, who are primarily financial institutions, many of them the regulation changed or the performance wasn't great, and it's left us in a pretty unique spot. And the GE transaction, which obviously has gotten a lot of press, one of the factors was, of course, that we had this large amount of capital and there weren't a ton of people similarly situated.
Yep. I promise this is the last one we were involved in that I'm going to ask you about. The GE transaction. And people have asked me how long did it take, and I tell them 25 years and 3 weeks. Yeah. But let's talk a little bit about that because as much of a headline as it was, I think that it's a good example of how your firm was able to respond quickly and why the one call came to you in the first place.
Yeah, I think the 25 years is a great point because sometimes people read this stuff and they think, oh, well, these guys have lots of capital, that's why they got it. But when somebody has to make a big decision, and in this case, GE Capital was tying the sale of their real estate business to this broader announcement. And by the way, we had no idea that that was going on. We only thought we were working on a big transaction. We didn't know they were going to make a much bigger announcement. But they're looking for somebody who not only has the capital, but somebody they can trust, who they feel like has a spirit of fair dealing and can move quickly. And if issues arise, which they always do, particularly in large, complicated, multi-jurisdictional transactions, you want somebody you feel comfortable dealing with. And so I think that was part of the equation as well. They called us. They said to us, look, we've got what ended up being $23 billion of real estate. We want to get this done in essentially 3 weeks. Can you do this? And we, of course, said sure. And what made it easier or achievable for us was because we had these different vehicles. As I described, we had this public mortgage trust that could take a big chunk of the debt. We had this high-yield mezz fund that could take a bunch of the debt, some of the foreign jurisdictions in Mexico. We had a big opportunistic European fund and a big opportunistic US fund. And so we had places to put this. Plus, we had platforms in logistics in Europe or office buildings in the US or shopping centers in Europe. We had people on the ground, and we knew a lot of these assets, some of which we'd sold. So there was an ability with our team, both our Blackstone team as well as the portfolio companies, where we could execute. Now, for the folks who work for me, for me too, but it was a very difficult few weeks. It was not a period of time where people were getting a lot of sleep. There was a lot of pizza in the conference rooms, but there was a real positive feeling. People were energized. They knew they had an opportunity to do something very interesting, and it fit really well with our business model. And ultimately, it was one of those situations that was a real win-win. I think the seller, in this case, GE, felt like they got a fair price from us. We felt like it was a fair price, and the stock market reacted in a very positive way to both the sale with us and the broader announcement. I think it added more than $40 billion of market cap to the company. I think it was a very shrewd thing that GE did, which was to tie the big announcement to a big transaction. So it worked out well for them. It worked out well for us. And it answered one of the questions we always get, which is our business grows. Are you going to be able to find new big opportunities? How can you make this work? And I always say I don't know, but invariably something comes along, and this was that something.
And there was a little bank involved in that?
Oh, I should mention, a little bank, your parent company, Wells Fargo, who we've known, again, for 25 years and had a tremendous relationship with. Tim Sloan, who runs the wholesale bank, has been a friend and partner forever with us. When we had the meeting, I had come down the elevator. I made one phone call before I even got back to the office to Tim, and I said, Tim, here's the deal, blah, blah, blah. He said, look, don't call anybody else. We want to be your partner. We want to do this. And the same sense of fair dealing and mutual trust existed between us and Wells. And again, this was complicated. They provided us financing. They were buying some loans. We were buying others. People had to work in the right spirit to have this happen as quickly as it did. Wells Fargo, another world-class organization, and I think for them it was also a win. So 3 wins.
Well, in fact, if you look on Friday morning after the announcement, BX was up, BXMT was up, GE was up, and Wells Fargo was up. So I think that the market liked the transaction overall. And I think the other piece of that, having been on the inside, is that at the end of the day, God bless our parent company, I don't believe they'd have ever gotten there without the leadership of someone who actually had the experience with the assets and ultimately had the experience with them. And it gets back to kind of one of the competitive advantages that you have as a company, and I want to transition a little bit more into what you've built and why there's an advantage to it at the end of the day. The ability to, in essence, evaluate over the period of 4 days, over 1,000 different assets in essence, and being able to get there. So talk a little bit about the culture that you've built there and ultimately how your vision for why it works.
Well, I'd say there are many people who deserve credit for what's happened here across our firm. And what's been created, I think, is very special because we've got a bunch of people who really enjoy what they do. I love my job. I think my partners really love what they do. And there's a real sense of teamwork and camaraderie and a shared sense of both mission and values. And there's a basic idea that we want to, invest in real estate, deliver great returns, do it with high integrity, and do it in a way that's a real team sort of fashion. And to do a transaction like this, you had to bring that all to bear. You had to have all your people around the globe willing to communicate on a regular basis, sharing information, identifying issues. You need an almost seamless organization. And the way our business has been built is with real integration. Every Monday morning at 9:30, all the real estate partners around the world are either in the room or on the phone together. At 10:30, the investment committee for our real estate group happens. which includes all real estate professionals as well as the leaders of the firm, Steve Schwarzman, Tony James. We go through our real estate transactions. Our acquisition teams regionally meet. They have review committees on Thursday globally for acquisitions around the world. We have strategy sessions in the different regions around the world. We bring everybody into New York once a year to go through all our investments.
You sit through all those meetings.
I sit through all that. Me and many of my partners travel a ton. If you don't like planes, this is not a good job for you. I was in Spain last week. I'll be in London and Paris next week. You have to really enjoy this. And then, of course, real-time communication, emailing, people talking to each other on a regular basis. And the question I also get, besides opportunities, is, aren't you going to, by definition, going to fail? You've gotten so big that there's no question your size will end up with your returns going down. And yet, year after year, we've continued to disprove that. And I think the key is to maintain our processes, to stay as integrated as possibly, sort of thinking globally, acting locally, staying in close communication, making sure that our standard of care, our investment committee materials, our reporting to investors, our valuations, our underwriting process, it's the same if a deal's looked at in Mumbai or Tokyo, if it's in Warsaw, London, Dallas, you name it, it should be exactly the same way. And part of that, of course, is we move our people around. So I think 40% of our partners have lived in different countries. Again, the idea of one common culture where people feel they have a collective interest in the success of the business. And that takes a long time to build, and it doesn't happen naturally, organically. I think it's one of the reasons why our business has a bit of a moat around it. I think there are some other great firms that ultimately can build great global real estate businesses, but it's hard. It takes a lot of time, and back to your point, the deal was done in 3 weeks, but it's really 25 years in 3 weeks.
I think the other thing that I've observed is that you've empowered a lot of young people early in their career. When I think of Tyler Henritze in the EOP days, or Nadeem back in the days when the first regional mall was bought 5 years ago, and now he's running around as a senior managing director within the firm. But I think that what you've done as a culture is you've empowered this younger group of people to ultimately grow and succeed.
Well, look, the danger, one was, as I was saying, being bureaucratic and siloed. But the other danger is that you create an environment where the folks at the top, they sit in there fat and happy, life's good, they've made a lot of money, hey, I don't have to work that hard, this is it. As soon as that happens, the young people who are really talented and driven, working hard, a culture, a not good dynamic develops, and resentments and other things. So to me, it's critically important that you create speed lanes for the best people, and you create really a hyper-meritocracy for people who are really capable of achieving, who work hard, talented, have good judgment, but also emphasize the team culture. I think that's really important. And if they do that, then they can move up quickly. So the co-heads of acquisitions, you mentioned them, Tyler and Nadeem, who I think are 33 and 34 respectively, got there because they've done a tremendous job. And we don't do this based on how many years you've sat in the seat. Now, oftentimes we have other talented people, we move them into different positions, we move them around the globe. But you want to constantly promote those great people, take care of them financially, obviously, but also give them professional development. And again, that's how you build a really great organization. You empower people, and you say to somebody, wow, if you're talented, you can move up. Kathleen McCarthy, who's the number 2, the COO of our business, joined us 3.5, 4 years ago. Another person, I think Kathleen might be 35, let's say. She joined us in IRBD, but it was clear she was super capable. She had an acquisitions background. We said, wow, you should be doing more. And we gave her more and more responsibility, and now she has this major role. She's actually out on maternity leave, which is really hard for me right now, but she is incredibly talented and driven and a major leader in our business. So I think to your point, without that, it's impossible. And as good as any one individual to create a business like this, you need a great enduring culture. And one of the challenges in the real estate business is often it's about one person, and that may be good for a deal or two, but that doesn't build an enduring franchise. Right. And I think if you look at the genius of Steve Schwarzman and you see the way he's empowered people, brought in incredibly talented people across our firm and allowed them to grow, I think that's the reason why the firm's had so much success.
So why don't you describe, again, primarily for the students, how you got from Chicago through Wharton and that English degree that you got to Blackstone, and ultimately from where you started to where you are today?
Well, I'd start particularly for the young folks to say I had no idea that I was going to get here. I didn't even know, I had no interest in real estate.
What did you think you were going to be when you went?
Besides an NBA
Yeah.
off guard. That didn't work out.
Couldn't go to his
No,
left.
no. I think initially I thought I was going to be a journalist, actually. So I was in college. I was this English major. I thought I'd be a journalist. I also had business interests. I love the stock market. So I ended up being in Wharton in finance. And the funny thing about my life is most of it can be tied to a 2-week period in 1992, in February of 1992, where in my romantic poetry class, which was the last thing I needed to fill out my English major, I meet a young woman. I'm still married to her. We have 4 daughters, one of whom's almost getting ready to go to college herself. And then I get a job working at a small investment and advisory firm, Blackstone. And at the time, Blackstone had no real estate. It just had a corporate business. And I went to work for that business, moved to New York, and learned a ton. It turned out to be hugely valuable for what I would do later in my career, where we take real estate and do it not just privately, but also with public companies as well. And about a year and a half into it, we were in the midst of coming out of another real estate crisis, the RTC crisis. And there were all these distressed assets, and the firm said we should get into this business. And they hired a couple of senior folks, and they needed some junior people. And one of the partners said, well, why don't you do this? And I said, I didn't really love the advisory business. I was doing these pitch books at the time, and I could do just principal work, and I said, sure. And that's basically how I got into the business. And the business, grew, and I got a chance to grow with it. And the thing I loved was the guys I worked for empowered me. John Schreiber, Tom Salak, John Kukrow. They gave me the opportunity to learn, to go out, learn about the real estate business, and if I had an idea or initiative, I could go chase after it. And ultimately, I'd say the biggest thing that took the business from where it was, which was sort of onesie-twosie buying, was when in the early 2000s, as the market heated up, we started thinking about doing more and more in this public arena, looking at bigger and bigger companies, and thinking about how we could take our model that we had done with individual assets, a couple of small public companies, and do it on a much bigger scale. And that's when the light bulb went out and the business really started to grow. But the whole time, I've enjoyed it. And one of the questions I get, like, why do you still do this? Why will I come home at whatever o'clock at night, get up in the morning, do emails to Asia or whatever, is because I really enjoy it. I enjoy the intellectual challenge of where's the best opportunity, where are things out of favor, where's there good value, where should we be selling, how can we make this company run better? Bought a big casino in Las Vegas, we bought shopping centers in China, like that intellectual challenge, and then the people side of it. The people you meet, I came here today, I saw a bunch of my friends who are here today, either speaking or participating, whatever. I love the people side of it, and so for me, I wake up every day energized about what I do, and that's why I do it, and to me, one of the questions people are now asking me, well, what are you going to be in 3 years or 5 years?
No,
I don't know.
Yeah.
I think of it like mountain climbing in the sense that you're always looking 2 or 3 steps ahead of you. You don't really want to look down because that's dangerous. You'll be like, oh my God, how did I get up here? And you don't want to look too far ahead because you don't know. But if you stick with what's gotten you here, that's been the best formula.
Do you think that the double major and an emphasis in English and the communication skills and sort of more of the left-hand side of the brain has helped relative to the balance that you seem to have in your investment philosophy?
I definitely think, by the way, having the ability to communicate, even if you're in a financial job, is hugely important. So being able to write a pitch or articulate a case for something in an investment committee memo is really important. Because if you can't convince a bunch of skeptical people that you should do this, then you're never going to get the glory for making a call about this investment, whatever it is. So having the ability, at the end of the day, investing is about thinking and then about communicating. By the way, being able to articulate things and speak to people and convince is all important. So for me, I think, yeah, it turned out to be really valuable.
Great. Okay, with that, I think we want to open it up for questions, if we have any here in the audience. Do we have microphones and things like that, or are people just going to raise their hand, stand up, and ask? Yeah, go ahead. There we go.
You mentioned that you had been doing, early in the Blackstone career, when you got into real estate, you had been doing these 1Z, 2Z acquisitions, and then you came up with the vision to scale it up, but it requires a lot more capital. How did you do that? How did you come up with the means for pursuing this bigger way to pursue the business?
We were fortunate, I guess, in the sense that we had had good success operating at a smaller scale, and as we started to grow and do bigger things, our investors gave us more capital. Also, it's interesting, the first really big public to private we did, extended stay hotels, Extended Stay America, we actually partnered with our private equity group because it was beyond our means at the time. Some of the deals, we brought in some co-investors as well when it went beyond the scale of what we could do. And then once we established a track record and people saw, wow, these folks can operate in scale, then it became much easier. But that is hard with a business sometimes because you might see bigger things out there, but you don't necessarily have access to capital. What I'd say today in the world is people are so hungry for great investment ideas. If you see something and you can act on it, you can generally find the capital. Somebody out there is looking for it, but it's not often easy, particularly at the toughest times. The hardest problem is generally the best investment opportunities exist when there's the least amount of capital. So today, of course, when it's getting tougher to invest as prices moved up, it's easier to raise capital. In 2009 and 1992, those periods, it's hard to find money.
Anyone else? There we go.
Yep. Yeah, go ahead.
Mr. Gray, I was wondering, one of the things that seems like you've done really well at Blackstone is notice that the underlying value of the assets of a company that you're examining, for instance, you talked about coming out of the housing crisis and now the Willis Tower, it's greater than the market value. And so I was wondering if you kind of see a similar opportunity now, maybe in the natural resources area, buying real estate, maybe for the underlying resources valuable, of that real estate with the oil prices currently so low.
So I like to stick with what I know, and I'm not an energy expert. What I would tell you, to me, though, the analogy on energy is interesting if you think about it in contrast to real estate. So in the oil business or globally, for the last 5 years, we added new supply, much of it because of the shale revolution here in this country, at a rate of more than 2% a year, and demand grew around 70 basis points. So we grew supply for 5 years at 3 times the rate of demand, and guess what happens? The commodity price collapses as a result. In commercial real estate in the US, we've really done the opposite. Coming out of the financial crisis, new supply has been growing at a rate that's a fraction of demand. And even today, this year, with the economy growing 2.5 to 3, we're seeing new starts at 1.1%. And by the way, that's the most positive thing about real estate today. The cap rates being low and us potentially moving into a Fed tightening cycle, that's the bit of the negative, but supply demand. So what I would say about energy, if the prices fall as they have, they seem to have fallen below the replacement cost of new energy, it is an interesting time to be an energy investor as a result. Anytime you can buy essentially hard assets below the cost of replacing, then you want to look in those sectors. My partners who run the energy business at Blackstone could give you a much more articulate and defined view of where to do that. But I think the basic instinct when an asset class falls the way that has, it becomes interesting. I think that makes a lot of sense.
Thanks for being here, Mr. Gray. As we've seen in the markets these days, a lot of asset-heavy companies like casinos and telecom companies are spinning off their real estate assets. Do you think this is simply the highest and best use of capital, or is there a concern that some of these operating companies are losing control of the most valuable assets?
I think it's a really good question. you know, obviously there is a financial arbitrage with a lot of these businesses where the real estate will trade at a higher multiple than their base business will. So if you took a retailer and you separated out their operating company from their real estate, you could create value. The challenge is, of course, what you've identified, which is, well, what if they want to shrink the number of stores they have? What if they want to change things in some way and they lose that flexibility once you separate the real estate and the operating company? I think it's a case-by-case basis. It depends on the nature of the business. There are also issues about what's going into REITs as a result, because some of the stuff is probably a little more aggressive than what traditionally has gone into the REIT format. And what you always worry about with a company is, am I doing something that ultimately will come back to bite me? Am I signing leases or doing things that make the underlying operating business unsustainable? So a lot of it also has to do with, you know, the ability to reject those leases over time. Are the lease rates escalating like this, straight lined up, which makes the real estate company great, but if it's a cyclical business, it's going to make it very difficult for the operating company. So I would say I don't have a view that it's great or it's bad. I think it's a case-by-case basis.
Thanks.
How you doing, Mr. Gray? I guess we just sort of walk up to the podium. I didn't know if this was the right way or not. I was just curious, you alluded to this earlier about post-Dodd-Frank, Volcker Rule, how that's affected the private equity industry. I was just wondering if you could elaborate on that and, you know, whatever you have to say about that.
Well, what I was saying was, you know, in the old days, financial institutions would buy real estate assets either on their own balance sheet or in funds. In fact, we bought from one of the banks a portfolio that included Serbian shopping centers and Argentinian office buildings that were on their balance sheets. And then a bunch of these guys ran funds as well, where they put in large amounts of their capital. And the regulatory environment has moved to a place that says, you know, that business probably should be done with folks who are not depository institutions, who don't have access to the Fed window, and are capitalized with equity capital that wants to take that risk and has liabilities that are discrete to that investment fund or that transaction, as opposed to tied to a much larger institution. And I think that trend, you know, will continue. And I think what's happening now, the dispersion of risk, is healthy for the system. So if you think about us, you know, we make a bad investment in one particular transaction, that goes bad, so be it. It doesn't create systemic risk. And what the regulators are trying to do is avoid this sort of domino effect, where a large financial institution makes some poor financial investment and it tips over to everything else they do, because it's one large balance sheet and it's all tied together. So that trend's continued. Now, there are all sorts of impacts of this regulatory environment beyond real estate, where financial institutions have to pull back from certain activities or are constrained the amount of leverage they can provide. And some of this will have an impact on the broader economy and the amount of credit availability and credit formation. And that's one of the tensions, but it's what happens when you come through a financial crisis. The natural reaction is to say, these big financial institutions, they caused a lot of harm to the economy. We should do a lot to reduce their size and slow them down. Some of that may be healthy and good. In the case of, I think, real estate, private equity, leveraged equity investing probably should be done in another format. Some of it, you know, could have other effects as well. And there's a balance, and I think smart people are trying to do the best they can.
At the beginning, you touched on your capital structure a little bit, and it sounds like, you know, overall you have about 34% leverage on the portfolio. Can you talk a little bit about how you make your capital allocation decisions? I mean, it sounds like low leverage at a point when that leverage is very cheap. So, you know, kind of walk through how you make that decision.
So we aggregated it all. Some of the businesses have very low leverage. Some of that equity we manage hasn't yet been deployed, but we manage the capital. So if you looked at our opportunistic business and just isolated that, that would probably be overall 60 to 65% leverage. You know, it depends on the type of fund and the risk appetite of our investors. We tend to be more comfortable with leverage, but to us, it's not the amount of leverage, it's whether we have covenants, whether we have term, whether there's heavy amortization. During the down cycle, some of the supposedly safe core funds who were lowly leveraged had unsecured bonds with covenants, and they ended up having to issue equity at the bottom of the market and dilute their investors. So for us, leverage is okay, but you have to be disciplined in how you use it. To date, we've had less than 1% losses in our entire portfolio over time, and I think part of it is we've been pretty disciplined.
Thank you.
I'm curious about the large U.S. residential bet you guys made at the bottom of the market. I understand that you're able to buy those assets extremely cheap, but the geography was spread across a number of different areas. How are you able to enhance the scalability of that acquisition? What are some of the things you're able to do and implement that allowed you to ultimately exit and make it an attractive purchase for somebody else?
So the key to us in the housing business, we bought 50,000 homes, was to get to scale and to do it in a defined number of markets. So we're in 14 markets, mostly in the Southwest and Southeast, where there were the biggest decline in home prices, the greatest distress. We've assembled what we think is a world-class management team to run this business, and we're building something that's going to look an awful lot like an apartment REIT. And if we can create that, and today we're 97% occupied against this portfolio, 70% of our underlying tenants are choosing to stay, which is much higher than what you see in the apartment business. We think we're building a real company that'll last a long time. And I would guess at some point, next 12 or 24 months, we'll have a business that can go public. But the key with this is to execute, to make sure we get the costs right, that we serve the tenants in the right way. What's fascinating is in the United States, there were, prior to the crisis, 13 million single-family homes that were rented out. It had just never been done on an institutional basis. So we're just taking a business that existed already, doing it in what seems like big scale, but small as a percentage of the market, and trying to do it in a very professional way. And I think it's going to work. I think public market investors will like it, but the jury is still out, and there are still plenty of skeptics out there.
There's a lot of international capital chasing real estate, for example, from China. How does it affect you and Blackstone?
So there's no question that if you said what's different today in the real estate landscape versus 10 or 15 years ago, I would say the amount of foreign capital and these huge pools of capital, particularly in sovereign wealth funds, who I think are rationally reacting to a world where you get 19 basis points for a German 10-year bond and similar for Japanese bonds and sub 2% for US bonds, and saying, look at this real estate, I can buy it at a decent price, the fundamentals are pretty good, I get a current yield and maybe some growth. The way it's impacted us, we benefited because many of these folks are investors with us. We benefited in the sense that we've sold to a number of them as well. But I would say what we tend to do, the majority of what we do, this opportunistic business, is harder for a large institution to do. So, buying a bunch of debt, cobbling that together, building an operating company from scratch, going into single-family housing, a bunch of the things we do, the messiness, complication tends to be less of what works for them. We're finding what they really want is something that looks like Roy was describing, fixed income plus. So if we can continue to manufacture core real estate, I think there'll be a good takeout over time. Some of them may get more aggressive and start to do direct on a basis with us, and that could create more of a competitive dynamic for our business.
Or they become part of your Core Plus fund.
Or they can come into our Core Plus fund. There's a bunch of things. I think net-net, it's good for the overall market globally. I think it's good for our business. Could create a bit of a competitive dynamic. So far, we haven't seen that.
Mr. Gray, in regards to your strategy in Spain, I'm interested to hear your perspective on the potential political risk of Greece right now and the whole kind of the ripple effect that could have throughout Europe. And also, I'm curious if Blackstone pursued any opportunities in Ireland, which is a country that has shown a better recovery so far than Spain. So I'm just kind of interested to hear your perspective on that.
So Ireland has been a really good market for us. We bought a lot of assets there. In fact, you helped us with one large portfolio of debt we bought from NAMA, which is their liquidation agency. The Irish economy, which is small, has really begun to turn, and I would expect Ireland to be a country that outperforms in a material way the next couple of years. The UK has also recovered nicely, particularly London. Spain has lagged a bit, but we see that now turning up. I think in Europe you've got three positive dynamics that are all coming about because of declines. The decline of the euro, which makes their goods much more competitive. The decline of energy prices, which helps consumers, obviously. And the decline of interest rates, which makes buying homes or capital purchases much cheaper. And I think all of that will help the European economies. I don't think they'll grow rapidly, but I think they'll grow. I do think there is some political risk today in Europe. You saw that in Greece, and that could spread. And there are parties in most of the major countries that are, have some pretty radical views around economies and capitalism. And interestingly, it's shared by the far left and the far right parties. And my hope is that as the economies gain some momentum, as unemployment goes down, it's gone down in Spain a couple hundred basis points, as there's a bit of growth, that people will tend to orient to where they naturally are, a little bit more towards the middle. But there is a risk that if you got one of these parties in place in one of the major economies, that could create real problems. What we're seeing in Greece is a small version of that. Fortunately, Greece is obviously a very small economy. If you had that happen in one of the larger economies and they also took on policies to reject debt or exit from the euro or do things that were more aggressive, that could be problematic. Our gut at the end of the day, Europe's going to get through this, that the euro will hold together, but that growth may not be really strong. I think the US is likely to grow faster, certainly for the next few years.
Thank you.
Two more, is that okay?
Oh, Mr. Gray, the idea of a land value tax is quite popular in some economic circles, and it seems to have some practical usage. I know a lot of wealthy East Asian countries, as well as my own home state of Pennsylvania, have implemented it. If the world saw greater implementation of that within its regulatory structure, how would that affect Blackstone's business?
And when you describe a land value tax, beyond a transfer tax, you're saying annually assessing beyond a property tax? Well,
I believe it's a tax assessed on the unimproved value of the land. So it's generally a tax that would be considered to discourage some speculation, but it's been used to great effect in some dilapidated urban areas, like Harrisburg, I believe, used it.
Force people to do something with the real estate
Or
and
give
not
it up
sit
to
on it.
somebody who would.
Look, I think tax policy is generally better as a positive, as a carrot versus a stick. Doing things in blighted urban areas to try to incentivize things with tax breaks, I'm a fan of that. Doing things with tax breaks to help affordable housing. One of the challenges of the gentrification we're seeing in places like New York and London and San Francisco is lower income and middle class families can't afford to stay in these places. So I'm a big fan of things that can help incentivize that kind of building. Doing things that adversely try to punish one set of parties versus the other, I'm not as much a fan of that. What we've seen in markets where you put in place very heavy transfer taxes is you get a lot less in the way of transactions. So New York used to have, what was it at one point, was it 7 or 8%?
7.5,
Yeah, and when they brought it down to 4, they've actually collected significantly more income. So taxation, I would say not an area of expertise, but I do think the government in certain areas can use it in a real positive way.
Thank you very much.
Thank you. So there are some new ventures that initiate some new business models, such as the real estate crowdfunding platform. And maybe now the transaction size of this platform, is small, but maybe, the future is promising. What do you see, about its influence on the existing real estate private equity field? Thank you.
In other words, the Core Plus funds, how do you see that impact on the other businesses that you're in?
I see it as a positive. I mean, one of the challenges in our business was we would raise money and we would meet with potential sellers and they'd think we'd only want very high rates of return. And so we were only able to do a small subset of the much larger universe of real estate transactions. Most deals are not opportunistic, producing really high rates of return. Most of them are pretty boring, straightforward. And so this gives us the ability to deal with public companies who want to sell off some stuff, maybe a 49% stake. Sometimes there are real estate private equity folks who want to cash out their own investors but continue to own the existing properties, bring in a new partner. And it's just given us much more dialogue with a lot of folks in the real estate world. I think it's been helpful to both businesses. So, and for our people, it's given them another tool. They can, do debt. We can do lower cost equity, higher cost equity. For us, we're finding it to be a very healthy ecosystem to have more data points, more ways to serve potential customers.
Okay. One last thing I just want to sort of sum up here, which is when you think about what John said today, what you'll hear is integrity, which obviously we've been involved, as I said, about $200 billion worth of stuff together. Not one deal have we seen a dollar's worth of retrade coming from the Blackstone side of a transaction. Phenomenal, and that means that there's an honesty in dealing. And so it's the integrity. It's the discretion. You go through these public companies, you don't hear about it until it's announced, which is very important. There's scale that ultimately has come through performance and ultimately building a culture that ultimately works. And I think that, as I describe you to people, you're the intelligent optimist at the end of the day. I think a good investor has to be an intelligent optimist, and he is one of the most intelligent and most optimistic people I know. And the other thing I say is that there's only two things in this man's life. It starts with his family and ends with his partners. And his partners, in terms of that constituency, are his operating partners, his investment partners, and ultimately his partners at Blackstone. Good guys can finish first.
He's the best. Thank you, guys.